The ability to access products or services or borrow money with the idea that you'll pay for them later is known as credit. Creditors, lenders, retailers, and service providers grant credit based on their belief that you can be relied upon to repay the amount you borrowed plus any associated finance charges. You are said to be creditworthy, or to have excellent credit, to the extent that creditors believe you are trustworthy to lend money to. In the United States today, creditors often use your credit history, your record of borrowing money and repaying it, as a starting point when deciding whether to provide you credit. 3 independent credit bureaus, Experian, TransUnion, and Equifax, generate files known as credit reports that describe your credit history. Your borrowing and repayment history is voluntarily reported to the credit bureaus by banks, credit unions, credit card companies, and other creditors. Your credit report contains information such as your number of credit card accounts, their borrowing limits, and current balances. The amounts of any loans you've taken out and how much of them you've paid back. Whether you made your monthly account payments on time, late, or missed them entirely. More serious financial losses like bankruptcy, auto repossessions, and mortgage foreclosure. Creditors frequently use a 3-digit number known as a credit score as the first factor in determining whether or not to grant credit in order to help them focus their lending decisions. Your credit score reduces the data on your credit reports to a form that is simple to understand and does it fairly, reducing the chance of prejudice. Credit scoring models are sophisticated systems that use intricate statistical analysis to determine your credit score from the information in your credit file. However, all models, including the FICO score and VantageScore, assign higher scores to people whose credit histories statistically make them more creditworthy than those with lower scores. 4 different forms of credit exist. Revolving credit. With revolving credit, there is a cap on how much you may borrow and how much you can charge. You are required to make a minimum payment each month, but outside that, you may pay the entire amount owed or any part of it. In the event of a partial payment, the remaining balance will be carried forward or revolved. Revolving credit is what most credit cards fall under. Charge cards. Once widely distributed by merchants for use only inside their own business, charge cards are now rather uncommon. Charge cards are used similarly to credit cards, but you are not allowed to carry a balance with them. Instead, you are required to pay off all charges in full each month. Service credit. Your agreements with service providers including cable and internet providers, cellular phone companies, gyms, and gas and electric utilities are all credit agreements. These businesses offer you their services on a monthly basis with the assumption that you will reimburse them later. Your service payment history can be taken into account by modern credit scoring models, such as the most recent iterations of the FICO registered score and VantageScore, but those payments aren't always recorded to the credit agencies. Installment credit. An installment credit is a loan for a certain amount that you agree to pay back over a predetermined period of time in a specified number of equal monthly payments, installments, plus interest and fees. Mortgages, auto loans, and student loans are a few instances of installment credit. If it hasn't happened yet, it won't be long before you find yourself in a scenario where someone demands to see your credit report. There are many misconceptions regarding credit, but establishing credit is essential even if you don't have the cash on hand to make a home or auto purchase. Credit reports and scores are used by businesses to assess your creditworthiness and determine your borrowing terms for everything from purchasing a new cell phone to a mortgage. Lenders use credit scores to determine the level of risk you offer as a borrower based on how you've handled debt in the past. You are more likely to have a good credit score and may have a higher chance of being approved for credit with favorable terms if you have a long history of making on-time payments and appropriately managing your debt. You can have trouble getting a new account approved if you don't have much credit history or if it contains bad information like late payments. And even if you are accepted, the terms will probably not be good. Although improving one's credit score can take some time, there are several advantages to doing so. Even if you don't anticipate applying for credit anytime soon, it's crucial to start building your credit score now so you'll be prepared for when you do.